We are live on the big old YouTube. So we are streaming live. Jody, I know you just kind of gave an overview of your past week and your trip to Miami and how amazing it sounded. And Tim, I know that you've got a wealth of information for us today based on the markets and what's been happening this week. So love to start it out with you and hear what you got to say. You're muted. Can you hear me? Tim, you're muted. You know that?
There we go. Hey, sorry about that.
That's
Yeah,
fine.
it's crazy week, huh? Talk about volatility. We've been talking about this, Kimberly, for some time, and now we're seeing it come to fruition. Hey, before I get into this, I want to give you, you guys are you're privileged. I just got off a long call with legal, and just a quick update on the. Is everybody aware, Kimberly? I think you have you talked about this before? The
What?
DOL fiduciary rule, that the new one that they're trying to pigeonhole insurance agents as fiduciary, that you know that you're responsible to act in a manner that you can only give advice for fees. Basically, you can't get commissions. Are you familiar with that new rule?
No. Is that in
So,
place?
well, yeah, what happened is
I mean,
the
I'm familiar with it before, right? When they came out, suitability,
yeah,
fiduciary,
this
blah,
is
blah,
this
blah.
has
But
gone through many iterations, and the DOL has come out in 2024 and basically said that the new fiduciary rule they presented now has come out that they're trying to put insurance agents, all of our people, into a fiduciary kind of box, and this is a big deal when obviously integrity and all the industry uh, giants out there are fighting this. And so I just got notice today, and I've been following this closely, but it looks like the Fifth Circuit District Court has stayed the DOL's rule and it's all of its related amendments. So basically, um, they've said the DOL has overstepped their authority. How do you like that one?
haha, I like it.
I like it a lot. So they said the DOL has overstepped their authority and that the ruling is outside of their scope that Congress has entitled them to do on the market as far as the Department of Labor. And they're obviously going to appeal it. This could drag on for years now if we go through the appeal process in this thing, and I'll talk more about this in coming months, but you've got so many players in this now as this expands, and you've got courts in Texas. You've got all kinds of lawsuits that are popping up over this in various agencies and organizations. So anyway, I wanted to give everybody a quick update. So basically, what this means is business as usual. So nothing will change in our
So
area.
good news, right?
It's great
In
news.
case you
Yeah.
hear some rumblings, we're all good to go.
Yeah. So let me bring everybody up to date. I got a fly in here. Let me bring everybody up to date real quick. So Monday, I call it Manic Monday. Remember that song? Um, so we had a little Manic Monday. $1 trillion was wiped off the balance sheet. I call it the perfect storm. There are a lot of things. I've been talking about this. In fact, we were talking about this over the last year. Just the volatility that is out there today is just amazing, and this is why our job and our where we are today is so important. Jody was talking about this is you know the risk recovery time now for people, especially as you get older, is more and more difficult. And so what we have is this great opportunity to help people during volatile times, which we definitely saw. So what happened on Monday was kind of a perfect storm connection between the Bank of Japan, who has been supporting the yen, and they've been putting trillions behind the yen, basically to support its valuation against the dollar. And then the all at the same time. So all this kind of converged at the same time. You've seen falling oil prices. because there've been some bad economic news and what happens when interest rates are coming down, the soft dollar, that impacts the dollar a lot of times. A weakening dollar, the Nikkei stock market dropped over very early on Monday, 12%. I think it was 18.2% over 2 days. So Friday and Monday, they're way ahead of us time wise. And Nvidia, Apple, all these techs did a pretty good sized correction over the last couple of weeks. And then the Bitcoin, this was interesting. All the cryptos had been falling as well. And so you have this kind of implosion going on of all these markets, everybody thought was safe. And then the announcement that Berkshire Hathaway had sold 49% of their Apple position. They still have a huge position, but that put Warren Buffett's cachet at about $288 billion on the sideline, the biggest ever in history. And then you have this interesting, it's called a carry trade, carry, C-A-R-R-Y, not carry as in person's name. The carry trade is when an investor borrows money from a country with a low interest rate and a weak currency like Japan and invests those funds in a place with higher interest rates. So it's kind of like an arbitrage situation. And the reason, this is good to understand is this is happening on a macro basis around the globe. And when those kind of trades happen and there's a huge interest rate correction basically in Japan, like what's going on, that screws up that trade. And so people got to cover that trade. And when you cover those kind of trade, the volume in there and what's going on a global basis, that causes a big disruption basically and a lot of selling. And so you've got that on top of all the geopolitical stuff in the Middle East and Ukraine. And then you've got the, Kamala Harris thing catapulting into the presidential race. And, there's a lot of unknowns going on here in our world and in the US and across the globe. And then also the second quarter earnings this year, 78% of the companies reporting have been beating the earnings. But here's the catch is 59% of the actual revenue forecasts have been lower than what has been expected. And then I saw this morning, this is interesting, Disney came out with their earnings, which beat expectations, but the attendance in their parks has been lower. So I don't know if anybody has gone to a Disney park lately, but I had a nephew go there with his kids and he came back, he said, Tim, it cost me $7,000 for 4 days. That's hotel, tickets, food, the whole thing.
Painful. For
yeah,
sure.
I mean, how do you afford to do that? So they're seeing, that's starting to hit. And this is something Jody has talked about and I've talked about. This is the market for active money managers right now. This is not a time for passive money managers. This is when active money management becomes a hot topic because it's easy to put your money in an ETF, let's say like the S&P 500 or any kind of index and get a pretty good return. But when you have this kind of movement in the markets now, we're going to see a lot more volatility for the rest of this year. And so that's why this time of year, Kimberly, as you know, is so important to emphasize the strength and the power of an index product, that the safety of zero is so important. And we can talk about any of the index products out there that we have, but they're all, anytime you protect the downside, that protection is so valuable because you participate in the upside. And what you're paying for is your limited upside protects the downside. That's what you're giving up is you don't get a 15% if the S&P is up 15%. You don't get that 15% during the year. You may only get 7 or 8%, but that is also giving you a floor of protection. And then one of the things we always talk about is if we go through another correction, you're down 20%, 30, 40, 50, even let's say 57% like we were back in 08 and 09, you have to go up over 100% to get your back to even, which you're not going to go up 100% in the market, I can assure you. So this is why protection, smart money is always going to protect your assets out there. So I'll turn that back over to you, Kimberly, but I think this is the dynamics of the rest of, I'd say 2024, 2025, 2026. I think for the next few years, we're going to see a lot of volatility, a lot of ups and downs in the market, in my opinion.
I agree completely. And, I think based on what you said, they really have two choices, right? If they want to be in the market, they have to be with an active money manager so they can mitigate that volatility. Or they have to choose an index, depending probably on how much money they have and how close they are to retirement, right? And what their risk tolerance is. But good news is we have the ability to help them in both of those arenas, regardless of what they're looking for. And we can help them navigate this uncertain time, which makes me proud, makes me happy.
Yep, absolutely.
Awesome. Thank you, Tim, so much. I look forward to continuing this conversation and seeing how it plays out for the rest of the year, for sure. So,
absolutely.
Jody?
Kimberly, one thing I was just going to say was that I just want you guys to understand how amazing the industry we're in is. And Tim, I don't even know if you even know this, but if you had to guess how much money JP Morgan moves every day.
Oh yeah, it's huge. I mean, I wouldn't even know where to begin.
It's $10 trillion. Now I want you just to stop. These guys move $10 trillion a day. And I verified that before I said it 3 times. So between around the world. And that's the business we're in, guys. If you just do anything, you're going to get wealthy. If you just act, you're going to fall into it. It's all around you. So exciting time. So I think now we're going to show up to the video that we have from last week. And then we got a great PowerPoint for some things I think you guys are going to love. So Kimberly, let's take it away.
All right, perfect. So, so that's what I'll start with. I'll start with the end of that video from last week. Remember, as Tim's talking about indexes and indexing, and both our IULs and our annuities participate in indexing, right? They use that strategy maybe a little differently, but it's still the same big strategy. So what I want you guys to think about and remember in this world is I want you to understand the big bubble concepts first. And then if you want to deep dive or need to deep dive and can go through that, great, fine, right? But I want you to understand conceptually how things are working. So we're going to finish the end of that video that talks about indexing and I think it's crediting methods, maybe buckets or things like that. So we'll finish that first. And then like Jody said, we have a great PowerPoint that we're going to pull up as well that's pretty fantastic. So let me do this. Actually, I have to stop my share for a second. So welcome to my technology, letting people in. All right, here we go.
I'll do that from here on. Sorry.
Say it again. Oh, okay.
I'll keep it on then. Sorry.
Okay. All right, here we go. So I'm going to press play. So index buckets and crediting methods. You know, we've gone through rates a few weeks ago, or maybe 2 weeks ago. And then we went through like par and cap and participation rates and things like that as well. So now we're going to talk about buckets and crediting methods. And remember, this is from North American, but the concepts are applicable to any company and products as long as you understand indexing.
Will have its own measuring period, its own 1 year measuring point that they're going to have. So why do we have different index segments and buckets? You can have multiple index segments and buckets at the same time. And the reason we have multiple ones is because, look, we're going to have different variations of things here. There's different premium timing. There's different index selections. There's different index crediting methods. So each one can have their own separate crediting. So for example, let's say, why don't we just say, well, why don't you just measure one period for the whole policy year? Well, not everyone pays their premium annually. What if they're paying their premium monthly? Well, then we're going to have monthly index buckets or index segments. And each premium payment is going to have its own little chunk or its own little bucket of funds that is going to be used to measure for that particular premium's 1 year period. So every index segment or every index bucket has a 1 year crediting or measuring period, but it does not start at the policy anniversary. It starts relative to when that premium is paid. For example, that month when the premium was paid. And so you could have, if you did monthly premiums, you may have 12 different index buckets or index segments, and each one of them might get a different return. Because, for example, the index will move up and down, and if the index credits from July to July might be different than the index credit from August until the following August, and September to the following September. So you're going to have different premium timing. Each premium may require a different bucket. Additionally, you may have different index selections. So, for example, they may use the S&P 500 index, and they may use the Fidelity Multi-Factor Yield Index, because each index is measuring a different measuring tool. The S&P 500 related index is going to look at the movement of the S&P 500. The Fidelity Multi-Factor Yield Index is going to look at the movement of the Fidelity Multi-Factor Yield Index itself. So those two may have different returns. They likely will have different returns. And because of that, each one is separated into its own bucket. So just wanted to kind of make sure that we're aware of that when you have multiple indexes, each one is separated into its own bucket. Now, they may also have different index crediting methods. For example, you may have the S&P 500 index, but you may have an S&P 500 index that is uncapped with a spread, and you may have an S&P 500 index that has a cap but no spread. So if you have, even though they're both using the S&P 500 as a measuring tool, they're different crediting methods. One using a spread and no cap, and one using a participation rate or a floor or uncapped method, or with a cap. They may have different measuring type of tools. Because they have different measuring tools, they're going to have their own separate buckets or separate segments. So as you can see, we're going to have a lot of different segments going on here, right? We have different premium timing. We have different index selections. We have different crediting methods. It's possible that just with one premium payment, you may have 3 different index selections, and then another different index crediting method. You might have 5 different buckets, for example, just with one premium payment. And then with another premium payment the next month, you may have another 5 buckets. And you can see how they kind of get larger in volume. Now, don't worry, at the end of the year, when you do annual reports, all of that is kind of shown together and melded together. But if you want to look at all the different index buckets and index segments and see what was the crediting for each one, you can do that. But you might just have one index bucket or index segment. Maybe they're paying annual, or they did a lump sum and they're just using one index selection with one crediting method. Maybe they're just doing S&P 500 point to point on a lump sum. Well, then you've only got one bucket. But I just want to kind of give you that flavor and idea as to why we have these different crediting methods. So the index growth is credited at the end of each segment or each bucket. They're going to calculate the growth at the end of that period. They are all annual measuring periods. They're all annually reset. And then you start with a new starting point for the next year when you're measuring that. The index is credits are locked in for that 1 year period. So basically what the annual reset means is that once you've received your interest credit for that year, that's locked in, that's done. We're going to start from a new point going forward. That's really important, because remember that graph that showed the S&P going down or an underlying index going down 16 and 22%, you won't have to worry about kind of recovering to get back to where you were with annual reset. You don't participate in any of the downsides, so your measuring point for the next year, for that next segment, starts at that point and goes up. The floor rate essentially makes sure that you can't take away prior interest. And so that's what really protects them from getting a negative return. Once you get those returns, they're there in their policy. The only thing that's going to take those away are essentially, of course, policy charges, mortality charges, because obviously this is life insurance and that's how life insurance works. Now, we do have another term that I think is of interest, and that is a minimum account value. The minimum account value is saying, okay, let's establish some sort of a minimum level that no matter what, you're going to get at least that amount. So the minimum account value is a separate bookkeeping entry that says, okay, what would your value of your life insurance policy, what would the value of your IUL be if we used a minimum type of return from policy inception until today? And then we're going to continually look at that and make sure that your policy's values are going to be at least that high at some point in the future. Usually we use it like a 10-year true-up period where your values will be at least the minimum rate of return at that 10-year period of time. And we're going to continually use that to make sure if we're looking to see, okay, would the policy lapse? Or if they surrender their policy, what's the minimum value? Now, typically a minimum value, by the way, there's no reset to the minimum value. You can get kind of ups and downs on a minimum value, but I'm going to I feel like I'm going a little ahead of some people. So let me back up a little bit. The minimum value is essentially a minimum rate of return, let's say 2%, 2.5%. It's probably more like 2%. A minimum rate of return that says, okay, we're going to keep a separate bookkeeping entry that says, what would your account value be if you had received a 2% rate of return in the fixed account, you're earning 2% each year for the last, for example, 10 years? What would your value be? And then let's compare that to what your actual value is. At the end of the 10-year period, we'll say, okay, if your actual return is lower than what the minimum account value return would be, then we're going to just raise the account value up to that minimum, what a 2% rate of return would have given you. Or if they're going to surrender the policy, let's say they're in year 8 and they surrender the policy, we'll look at their actual surrender value and we'll compare that to what their surrender value would be if they had a 2% rate of return each year for the past 8 years. And then compare the two, and they'll get the greater of the two. So this is just kind of a nice little feel-good type of thing. It's likely, it's not like you're really selling off of that. If you were selling off of that, you'd probably be just using the fixed account. But essentially, the minimum account value gives you that kind of that assurance that, okay, there's going to be at least a minimal type of return of credits into the policy when you surrender the policy or every 10 years. Now that's going to be reflected in the illustration. You'll see that in the illustration. If you happen to illustrate something below 2% or something like that, you could see it, but it's unlikely because usually credit index credits that you're illustrating are significantly higher than that. But just to if you have additional questions, you can always call your dedicated, internal marketer or wholesaler or whoever, and they can help you explain that a little bit more. But this is just to kind of give you a flavor that there is some sort of a minimum. It's not just a pure zero. There's a minimum return on the policy of at least a 2%, what you would receive had you got a 2% per year each year in the fixed account. Okay, so how an index value is credited or giving a segment bucket. North American offers, we offer a point-to-point, an annual point-to-point. We offer a point-to-point with spread, and we offer a monthly point-to-point. So let's go through and kind of go through this, and I'm going to have to fly a little bit to try and keep this on the hour because there's some examples here I want to give you to how this is actually credited so you can see how this works. So we look at the ending value and the beginning value. Basically, we're looking at the difference between the ending value and the beginning value. So how much did the underlying index go up? Did it go up 5%? Did it go up 10? Whatever. So let's say it went up 10% or whatever. Then we apply a participation rate. The participation rate, we've already described that. Then we look at the cap and floor rates. And we've already described those too. And then we apply any bonus if applicable. Many of our policies have bonuses, or some of our indexes specifically have bonuses. And then we multiply the account times the index account value. That's how you credit interest. You look, how much did the index move? We apply some of our rates, participation rate, cap or floor rates, bonus rates, and then you get the index credits. So let's look at examples. Here's a hypothetical, very hypothetical. Index was 1,500. We had $10,000 in there, ignoring policy charges. Cap was 10. Participation rate is 100%. Floor is 0. Bonus 0.75. Let's look at some examples. The underlying index went up 46.67%. Okay, we're at 100% participation rate, 46.67. Our cap rate is 10. Okay, so now we're limited to 10. But let's say that they're in an interest rate bonus period and they get a 0.75% bonus. Then we add our 0.75% bonus on top of that, which is 10.75. And in the second row here, the index went up 6.67. The bonus, if applicable, in this example it is, and then that's the index credits. Now in the third row, we have the underlying index went down. It started at 1,500, went down to 1,000. That's a 33% rate. It's 33% loss, but we have a floor rate of 0. And so if the floor rate is 0, you get a 0% credit. In a
Hello, Kimberly said she's coming back. She's trying to solve some technical issues.
Thank you.
Thank you.
welcome. You're welcome.
What was the question?
The presentation is not showing anymore, Jody. So
I think
Kimberly
they're
said,
going back on here.
yeah, she's coming back.
Hey,
Hi,
Kimberly.
that was fun. That is called too much water for the internet to handle. All right, are we good?
It's not showing, but if you want to, we can switch over to the flip chart.
It's up to y'all. We can finish that last minute or two, or we can flip over the flip chart. What you want to do?
I vote PowerPoint because, hey, listen, guys, when you see this PowerPoint, it's going to help you understand what you just heard. It will give you a very fundamental thing that I think that this ought to be a class that people have once they're licensed and once they get there, start writing business. This is something they need to do. So you'll really like this. So let's just go right into that.
Okay, and I'll send out that North American link in full, so you guys can watch it or watch it in those pieces and finish it up, so you can watch it on your own as well. So you have that, just in case you were like totally enveloped in that conversation. Okay, I am not the host. Who's the host at the moment? Jody, can you make me the host?
Yes.
I'm on my cell phone hotspot now, so we should be good to go, but no promises.
Yeah. Everything's kind of acted up all of a sudden.
Mhm.
That should do it.
All right, perfect. And you're the co-host, so we're good to go. Okay, awesome. Are you going to go through this PowerPoint, or am I going to go through this PowerPoint?
That's you leading it, and I'll be right with you.
Okay. All right, so let me share this screen. I don't know where it went. Do y'all see it?
No. There we go.
All right, so we're going to start at the beginning, obviously, from the beginning, and go through this together. So understanding terminology, and like Jody said, this is great for all of us probably to refresh what it means, but it's really great for a brand new person to come in and just simplify the conversation. So understanding terminology. If you want to be successful, you must embrace the boredom of consistency, right? So sometimes it's boring, but it's all right, right? We just keep going and go forward. So what does face value mean? When you hear the word face value, what does that mean? That means a death benefit. If you hear face value, it also means death benefit. The amount paid to the beneficiary upon the death of an insured person. So both of those obviously are simultaneous. A lot of times you'll hear face value, but you might not know what that meant. And just remember, when you hear that, that means death benefit. Proposed insured, what does that mean? The proposed insured is the person on a life insurance application that would be covered by that life insurance policy. So it is the person that the life insurance policy is on. Who is the policy owner? The policy owner is a person, company, or trust, it can be any of those things, who owns an individual insurance policy. This person may be the insured, meaning if the policy is on myself and I'm the insured, right, then I can be the policy owner as well. Or it could be the beneficiary. Zach could own a policy on me, or it could be someone else, maybe a business partner or something like that. But the policy owner is a person, company, or trust who owns that individual insurance policy, not necessarily the insured. The policy owner usually is the one who has the insurable interest and mostly is the one who pays the premium and is the only person who may make changes to the policy. So if Zach had a policy on me, he had a policy on my life, right? I'm the insured and Zach is the owner. I could not make changes to the beneficiary or to the premium payments or anything on that policy, even though the policy was on my life, because he was the owner on that policy. He would have to do that. Another thing to remember when it said, the policy owner usually has insurable interest, and we might talk about this in a minute. If we do, I'll repeat that here. But insurable interest, I was always told, means love or money. How do you know if someone has an insurable interest in you, right? It is love or money. So if it's a business, it's a money conversation. If it's my spouse, it's obviously love, right? My children, my grandkids, my stepkids, whatever. But remember that insurable interest means love or money. The payor. In most cases, the person who's applying for the life insurance will be the person paying for it, right? Who is paying for that life insurance? If the premium payor, the person paying for the policy, is going to be someone other than the insured or the owner of the policy, the insurance carrier will want to know that person's relationship to the insured and owner and the reason they're being listed as payor, right? Just makes sense to have a reason to be paying for somebody else's life insurance policy. What does beneficiary mean? What does that look like? Primary beneficiary, an individual or organization who's first in line to receive benefits upon the insured's death. An individual can name multiple primary beneficiaries and just decide how distributions would be allocated. If I wanted to have 10 people as my primary beneficiary, I could, right? I could say 10% to all of them, or I could say 50% to one and divide the rest of it equally, or I could make those changes however I chose to do so. A contingent beneficiary, because you'll see both of those on a life insurance application. That's someone that receives the benefits of the account if the primary beneficiary can't after the account owner's death. So I see this most often, like husband and wife get a life insurance policy, right? So for myself and Zach, we have a life insurance policy on me. Zach is the primary beneficiary. If something happens to me, Zach gets all the money, right? Which is why I sleep with one eye open. I'm just kidding. But if something happened to Zach and I together, our kids are the contingent beneficiaries, meaning if neither of us are around anymore, our kids will get that death benefit before it would go to the estate. Sometimes people just leave it to their estate, but that's what that means. All right, cash value or surrender value. F&G, I guess this is surrender value. Let me ignore my scam likely so they don't kick me off the internet. F&G, the surrender value is 15 years to receive the cash value. That means that if I surrendered the policy in the first 15 years of that and just said, you know, I don't want this anymore. I just want all this money that I've made, money that I've put in, you're going to have a penalty within the first 15 years of that policy with F&G. You can't pull it all back out. It's a decreasing surrender. Both annuities and life insurance policies or cash value life insurance policies have it. It is a decreasing surrender, but it's still, you're not going to get it all out without a penalty before that period of time. These are long-term contracts, not short-term decisions. So remember that. AIG's surrender value is 14 years. North American is 10 years. And then obviously the difference between the cash value and the surrender value is the surrender charge. If you guys have seen me go over a policy illustration before, then you've seen me explain the difference between those two columns and say, see here, when they're exactly the same, that means you don't have a surrender penalty anymore going forward. And you guys can kind of see that in the illustration. Modified endowment contract or a MEC. This is something that most of the time we intentionally avoid. So a modified endowment contract, MEC, is a tax qualification of a life insurance policy whose cumulative premiums exceed the federal tax law limits. The taxation structure and IRS policy classification changes after becoming a modified endowment policy. So our goal with these life insurance policies, 99% of the time, I would say, is to put after-tax dollars in, allow it to grow tax deferred, and have tax-free access on the back end. That is our goal with that. If we overfund it, if we put more in than the bucket will hold, right? That's when it becomes a taxable event and it becomes a MEC, and you kind of undid all the purposes of having the tax benefits there. All single premium contracts, one and done, which has its appeal. Some people just love the idea of being able to make one big life insurance payment and be done with it forever. The money can grow tax deferred in that example, but it will be taxable at the time of distribution. The death benefit would still be tax-free if we're talking about a MEC in this example, right? So again, one big payment to a life insurance policy, they're done with it forever. The money inside that policy will be tax deferred as it grows. But if you use it as income while you're alive, that's going to be taxable if it's in a MEC status. The death benefit going to your beneficiaries would still be tax-free. Once a policy has been classified as a MEC, it cannot regain its former tax advantages under any circumstances. The MEC classification is irrevocable. So that's why we pay attention to those guidelines and the maximums that the policies say that we can put in, because we do not want to overfund that bucket, because we don't want to be taxable, obviously. And typically, also, just so you know, an insurance company is going to send you a big old warning letter that says, hey, if you continue to do this, or let me send you this premium back so we don't get in this situation. But it's also important for you to understand what that is as well, if you have any concern about overfunding that bucket.
Yeah, it is probably the one thing you want to avoid at all costs.
Yeah, unless you're doing it for a different reason. I agree. 7-pay test premium. What does that mean? It places a limit on the amount of money that can be put into a life insurance contract. Any policy that fails this test is classified as a MEC. Some of you guys might be super experienced in this world and you understand where the target premium and the 7-pay premium and the single pay premium and all of that is on an illustration. Some of you might have no idea what I'm talking about. The good news is if you run your illustrations where you through the software, which all of you will and all of you do, it prints those out for you, and you just need to understand what that means and what that looks like. PDF or PDA, a premium deposit fund or a premium deposit agreement. What does that mean? It allows you to put a lump sum of money up front and structure those premium payments over a period of time to prevent the policy from becoming a MEC. So remember, if I wanted to dump $100,000 into a policy, just a traditional policy, I probably MEC'd it, right? I probably put too much into that policy at that time. But if I put it into a premium deposit fund in that policy, or a premium deposit agreement in that policy, then we can pull out a certain amount per year and it will pay itself, but that entire amount didn't actually go in at one time. So it prevents the policy from becoming a MEC, and the client will not have to worry about making additional payments in that example. Minimum premium.
One thing, guys, listen, don't let your eyes glaze over, because I understand this. We talk about it in Bob, how we teach people the new rules of money and the tricks of the wealthy. These are the rules. These are the rules that make this legal. These are the rules that allow for the tax-free withdrawal. So these are really pretty dang cool.
Sure. Absolutely. Minimum premium and target premium. What does that mean? So the minimum premium is the amount that has to be paid into the policy to keep the policy in force, obviously meaning minimum. This amount is usually not sufficient to keep the coverage in force for life, unless the insured is very, very young. So we don't typically run illustrations and policies and only pay the minimum premium, because at some point it's going to set them up for failure. Target premium is the preferred option. That is what we should be striving for on all of the policies that we write. Factors that influence a life insurance premium, like why do I get a better rating than somebody else, or somebody else gets a better rating for me? What does that look like? Obviously, age. Remember, insurance, we're managing risk, and with our risk comes this calculated understanding of we hear actuaries and things like that. They know based on our age and other factors probably when we're going to die, which is morbid and horrible, but that's how they as a company understand how to rate you, right? How much it's going to cost you, because now they know their risk as well. So age is one of those things. If you're older, it's more expensive. Gender, males are typically more expensive than females. The quality of your health and your family history. Even if you're super healthy, you'll notice on a lot of applications that ask if you had a mom or dad that died of heart attack or cancer before age 60, because they are looking at your family history to determine, based on all of your other factors, you know, what they think your longevity is. Hazardous hobbies, activities like mountain climbing, scuba diving, etc. Obviously, those are more dangerous, and those are things that you can't really calculate risk in, other than you know they're riskier, so it should probably cost a little more for you to have life insurance. Your height and weight. Are you underweight, or are you overweight? Or are you just right? But they're going to look at all of that and see where you are. How often do you travel internationally, and where do you travel internationally, right? I think going to London's probably different than going to the Middle East. And so they look at all of that and ask those questions in your international travel and that foreign travel questionnaire. Your occupation. Do you have a high risk occupation like a pilot or a truck driver, a police officer, fireman, something like that? Because that obviously might bring more risk. Are you a smoker versus a non-smoker? And vaping counts as smoking, so understand that when you're talking to people going forward. You know, I always tell people, a lot of times, especially with vaping, they don't really consider themselves a smoker. So if you ask it that way, they're like, oh no, I don't smoke. And then it comes back and you're like, well, you have nicotine in your blood. Well, I vape. Well, that's the same thing, right? And I just make a joke out of it because that's all you can do. But I'm just like, well, you being a smoker is better for me. It's significantly more expensive for you, but that means I make more money. And they're like, ha, 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 you know, but ultimately smokers cost a lot more than non-smokers because the probability of them dying sooner is higher, obviously. Risk classification, class, or rating. The risk classification, also known as risk class, is used to determine the premium on your life insurance policy. So the most common risk classes used: super or preferred plus, preferred, standard plus, standard, preferred smoker, standard smoker, and then substandard. If you're substandard, a lot of the companies, you know, will either rate you as that, or they'll come back and say, hey, you're substandard table B, and you have to kind of go through your illustration again and see what that looks like. But you're not going to be able to make a decision on table ratings outside of underwriting. And also remember, your different carriers have different ones of these. Like North American has 3 rate classes, right? Before you go into the substandard. So they have, like, I don't know if it's preferred non-tobacco, maybe it's preferred plus, preferred non-tobacco, and then standard, but they have 3, right? AIG has 4. So they have preferred non-tobacco, preferred plus, standard plus, and then standard. So you have a little more chance to have, you know, to fall somewhere in the middle with Corebridge, right? So look at that and just understand what those options are and how that looks. Table ratings from substandard. Table rating A standard is your standard rate plus a 25% charge. It's a lot more expensive to be unhealthy. Table rating B is the standard rate plus 50%. C is standard rate plus 75%. D is standard rate plus 100%. E is standard rate plus 125. F is standard rate plus 150. G is standard rate plus 175. I didn't know they had this many tables. H is standard plus 200. I standard plus 225. J standard plus 250. The thing I will tell you about these table ratings, if they come back and they say, hey, your client is table rating G, I don't think you need to take the standard price and multiply it by 175. Just go in into your software and say they're substandard table G, and it will calculate that for you. But it is it makes sense to understand kind of how that works, and that A is best if you had to be rated, J is worse, like it goes in that direction. Flat extra premiums. A flat extra premium is an amount of money added to the base premium of your policy for the life of your policy or for a set period of time. They could say, hey, I noticed you had, I'm just making this up, it might not be a thing, so don't quote me, but I noticed you had breast cancer 5 years ago. We're going to give you a flat extra premium for the next 10 years that you're going to pay on this policy. And after 10 years, that'll drop off, right? They're managing their risk of recurrence in that 10-year period of time. But that's what a flat extra premium is. Again, it's either for the lifetime of the policy or for a set period of time. Temporary flat extra is another word that you might hear, or permanent flat extra. Temporary means it's going to expire. Permanent means it's forever, right? cap rates, which we've talked about the last 3 weeks, how that works. A
And
cap,
Kimberly,
Mhm.
real quick, and you may have said this, but I don't think you did. But if you are rated, especially if it's like a weight thing or something, you can go back and at the end of a year and try to change that.
Yeah, so a lot of times, if you're weighted based on rate or being a smoker and you have intentions of not smoking, you're not going to get it to change immediately, right? So it's best to accept the policy that you have an option to take, so you at least have some life insurance. And then when that changes, whether it's weight, so you can reapply in a year, or if it's smoking, some companies are years, some are 3 years. You just have to read the rules and regulations. Then you can reapply. But it's very important for you guys to remember that you are annualized on all of these premiums and all of these life insurance policies. So if I convince someone to take the standard rating today based on their weight, and they think in 6 months they're going to have lost all this weight and want to reapply, if I don't make them wait for at least a year, and I would say 13 months, just to kind of give yourself a little hedge, I'm going to get a chargeback if they cancel that policy prior to a year. So remember that. You want to make sure that they know, hey, this is the best case scenario for now. Let's accept it. When you've lost weight or quit smoking or whatever, at least a year from now, not any earlier, then we'll reapply and do that then. So it's important to know that. But cap rate. A cap rate is the highest percentage gain that the insurance company will credit to your account during the specified period. Again, we've talked about this over the last several weeks. So if you have a 10% cap, that's the maximum you're going to make. Even if the market returns 20%, you're going to get 10 of that. This means that if your annuity has a cap rate of 8% and the benchmark index goes to 12, you'll be credited with 8. Participation rate. A participation rate refers to the percentage of the benchmark index gain the insurance company will credit to your annuity for a specified period of time. So, for example, if the participation rate is 50% and the market index goes up 12%, you will be credited with 6%, right? So 12% times 50% is obviously 6%. And so that's what you would get in that 50% participation rate situation. What does this one say? This one just gives us pretty flowers. All right, a spread. A spread is the fee applied to any growth in the index. For example, if there's a 4% spread and the index was up 10% that year, you would only get the benefit of 6%. So in a spread, the insurance company gets the first percentage, whatever that is, whatever your spread rate is. So the first 4% of any growth goes to the insurance company, and then over that you get the difference, right? So in this example, the spread rate is 4%, the index return 10, so the insurance company gets 4%, your client gets 6. 1035 exchange. A 1035 exchange is a provision in the tax code which allows you as the policyholder to transfer funds from a life insurance policy to a new life insurance policy without having to pay tax. So we call that a 1035 exchange. In your mind, it's probably similar like a 401k rollover, right? It's just the paperwork that allows you to avoid paying taxes on any of that growth if you're transferring it from one insurance policy to another.
Yeah, similar to a transaction too.
What?
It's similar to a real estate transaction.
Like a 1031 or something like that. Yeah, let me see. Do we know how many more of these there are, Jody? Any idea?
You can put a pin in it.
Huh?
Put a pin in it right here on this one.
Okay. Let me just, I got it on my phone too, so let me just scroll really fast.
As we're going to have this, we're going to change the look of it just a little bit. This information, we'll have it right out to you because I know everybody's going to be asking for this because this is a great reference source for you. Just to have and to use whenever you need it.
So I'll go through this. I'll go through them really fast because I've got a call right after this that I'll have to jump onto. But I'll go through them really fast and then we'll continue to go through this through the next few weeks. So policy loan, one of the biggest advantages of owning a permanent life insurance policy is that over time it builds equity, also known as cash value, which we talk about a lot. Once it's accumulated, you can use it anytime for any reason. You can help pay for unexpected expenses, pay off a debt, college funding, supplement retirement, or for any other need. The life insurance company won't run a credit check, so you can be approved for the loan as long as there's enough cash value built up on your policy. What's
Yeah,
more,
I
because
want to say something real quick. I honestly, I had never thought of that till I read this.
yeah,
And that's one reason I wanted to show this presentation, because
yeah,
that
you
got
don't
my,
have to qualify to borrow your own money. If you
that's
put
a
all the
huge
money in the
deal.
walls of your house, you still have to be worthy to borrow the money that you've stuck in the walls of your house, right? So no hard inquiry into your credit. It's not gonna hurt your credit score, which is just another perk. Types of loans. You've got standard and fixed loans, participating index variable loan, a standard fixed loan, AIG. 1 to 11 years, they have a 3% charge, 2% credit. This is probably something good to at least keep the snapshot of how this works in case a client asks you, since they broke it down per carrier. It's pretty great. So look at this. The first 11 years, it's a 3% charge and 2% credit. So kinda, not exactly, but kinda, you're paying 1% for that. After 11 years, it's a wash loan, meaning you're not paying anything to borrow your money on a standard or a fixed loan. North American, 1 to 5 years, 2.75% charge, 1.5% credit, 6 years plus it's a wash loan. F&G, the first 10 years, it's 2%. After that, it's a wash loan. Participating indexed or variable loans, which I think are the ones that we typically use. So then it's still participating in the returns in the market. AIG current loan rate's 4.5%. The max rate is 8%. North American current loan rate is 4.3%. Max is 6%. F&G, I don't know because it's not there. Oh, Gold. F&G Gold max rate is 5.5. Freedom is 5. And Jody, it might be good to ask whoever put this to put the date that these rates are current, because those do change, and that way if they change, we could edit them and kind of know, when to look back at it.
Sounds
Also,
good.
insurance company ratings. We refer to the ratings by three companies: AM Best, Fitch, and S&P, which are accredited with the U.S. Securities and Exchange Commission and registered ratings of insurance companies. And these are the different ratings for the different companies and their brochures. Obviously, you guys know we only deal with top class carriers. FIFO or LIFO. FIFO means first in, first out. In life insurance contracts, whatever you've paid in up to the basis comes out first, and then the remaining is accessed via policy loan provision. So if I put over the course of my investments, I put $100,000 in my life insurance policy, I'm going to pull out that first $100,000 just because it's my money, right? And then I will go into the policy loan provisions with the remaining. Last in, first out is mostly in a MEC contract and all of your annuities. The gains are paid first and are taxed, and then the premiums are paid last. So if I put $100,000 in an annuity and I have a $200,000 value, the first growth is going to come out taxable to me, and then that last 100,000 will come out tax free because I've already paid taxes on it. So remember that. Your tax corridor is the difference between a policy's death benefit and its cash value. To qualify for a life insurance and receive favorable federal tax treatment, a life insurance policy must attain at least a specified corridor, which your illustrations are going to do for you. So that is a quick overview and end of that presentation. But I definitely think it's a great presentation and kind of goes along with some of the videos that we've been watching and the conversations we've been having over the last few weeks.
Hey, and also Edwin's actually here in the office, and we were just talking, and with the new leadership mastery, which we have and will be unveiled real strong at the convention, we're going to put this exact piece in the training module that's on there, so it'll be right there for you. Plus, we'll get it out to you as well. So thank you, Kimberly, for all that you do. And it was a great call. Tim was awesome today, very, very powerful. And listen, there were some great things said today, and I want you to listen to what Tim had to tell you. Always Kimberly's perspective, and that fact about, hey, what we do for people is just fantastic. That is one of the whole things that you'll hear about all the time, that Grant Cardone talks about a lot, is that people get all this equity in their houses, and it is all beholden to their own personal credit. And I promise you, if you're honest with yourself, it's a lower percentage versus a higher percentage of people that right now could even qualify to get the money out of their own house. And that's a big deal. So that's a good thing.
Jody, you have two people that have their hand raised. I don't know if you want to do that or take it offline.
Sure.
It's up to you.
Guys, what's the question?
Hi there. Well, thank you, Kimberly. Thank you, Jody. This is Marty from Stephanie Pinto and
Yes.
Ritzy. I was over here. I just can they share that PDF, or can we find it in the back office, or is that something?
I'll get this to you by the end of the week. I'll get it to them.
Okay, wonderful. Thank you again, guys. Thank you
Thank
so
you.
much.
Thank you. Anyone else, or is that the same question? Octavio? All right, sounds perfect. All right, well, see you soon,
Thanks,
guys.
guys.
I'm gonna run to another appointment, so I'm not
At
late.
1:30, I'm doing the bot for slanted toward realtors and CPAs. If you want to watch it or get people on. Bye.
Thank you, guys.
Bye, guys.
Kimberly, question. Sorry.
Yes.
Do you have time maybe so we can go over? Because I know our team down here in Miami would love to hear a lot of this information. If you don't have it in Spanish, we can maybe work on translating some of it. Hi, Jody. How you doing today?
I'm great, buddy. I'm actually sitting with Peter and Edwin. Let me talk to them first. And by the way, guys, this is Octavio, who does an incredible job of translating for a lot of our events. So
And it is live streamed to YouTube. So all of today was recorded on our YouTube channel.
But yes, we will. I'll get with you and we'll coordinate that.
Thank you so much. I appreciate it. Thank you so much,
We
Kimberly.
thank you. We appreciate you.
Thank you, Jody. Appreciate it.